Hi friends, welcome to IFRS Pro. So any idea what is this IFRS? So if you go to the basic root level fundamentals, how the financial statements of any enterprise can be prepared. For example, if I'm a sole trader or if I'm a company, I have to prepare my P&L balance sheet. So how do I prepare? Who decides the accounting rules? So there is something called applicable financial reporting framework, which in general refers to legal requirements and accounting requirements. So in IFRS, FR stands for financial reporting. Financial reporting means every business enterprise, whether you are profit oriented or not profit oriented, whether you are government or any kind of organization, you need to prepare your financial statements and you need to report it to the shareholders, stakeholders, government, etc. So in every country, you take India, you take any other country, every country has their own set of accounting standards. We call them domestic accounting standards, or in simple terms, they are accounting standards. But the way how you write your accounting, you write your books of account, you prepare your financial statement, if it is substantially different from the accounting followed by another country, in this era of globalization, don't you think it creates a lot of differences and it creates confusion to the investors? So we have been, reading news that many global enterprises are investing money in, other countries. Like you take Reliance, there is so much of money flowing from Facebook, Google. So there are so many other investors as well. So a person like Mark Zuckerberg who sits in US, do you think he understands Indian accounting standards? Even if he knows accounting also, do you think he understands Indian accounting standards? So there is a requirement to converge, to harmonize domestic accounting standards with global standards. India is also a mission of this, and in 2014, Ministry of Corporate Affairs, they have started implementing this International Financial Reporting Standards. In India, they are known as IND-AS, IND-AS. So trust me, with all my 1.5 to 2 decades of teaching experience and in my experience in accounting, I can tell you one thing. The future is going to be IFRS. You call it with any name, but trust me, the future is going to be IFRS. After 5 years, I visualize, I can see all the enterprises in all the industries across the globe preparing their financial statements only in compliance with international financial reporting standards. So I learned this IFRS from Ernst & Young, and along with my colleagues who are also trained with Deloitte and PwC, we have launched a course on IFRS, not only to help the students pursuing professional courses like, ACCA, CPA, CMA USA, and also Indian courses CA, CA, CS, because this is the tomorrow of the accounting. Not only the students from India, to cater to the requirement of students globally, we have started this IFRS. So today in this very short video, I will give you a classic example on how the new system is changing the accounting. So we wonder, I'm really surprised when I started studying IFRS in 2015. I was really surprised. This kind of questions never came to my mind, whether as a student of chartered accountancy or cost accountancy, or even after that as a practicing CA when I'm conducting accounting and audit of so many enterprises, or as a consultant or as an auditor. I have never thought of these kind of things. So I'm so happy that this new system, the global accounting, is opening doors to innovative thinking, and this is increasing the scope. So from rule-based accounting, happily I can say we are marching towards principle-based accounting. So you need to use a lot of common sense here. So I'll show you one example what I have come across as a student of IFRS. So I'm very sure you'll enjoy this example. So it is something like this. A incorporation, an enterprise, bought a factory for $1 million US. This is relevant for both global accounting and also Indian accounting, whether you are doing IND-AS in CA final level or accounting standards in CA intermediate or IPCC level. This question is relevant for you. But trust me, you might never have seen this example unless you are a student of IFRS. Okay, so An entity bought a factory with 1 million US dollars. The factory consists of various assets. So it is, basically group of assets with the fair values as given below. Serial number 1, land, which is having an individual fair value. As such, the individual specific asset has a fair value of 2 lakh US dollars. Then the second item is building, 3 lakh US dollars. Then third item is machinery, 2 lakh US dollars. And the fourth item is furniture, 1 lakh dollars. So total it is 8 lakh dollars. How do you recognize the above transaction in the books of account of the entity? So can you tell me? So just read the question once again. Just read the question. Now the problem here is, visualize the situation. You went to a person who owns a factory. You entered inside, the factory is for sale. You saw land is a beautiful, piece of land in a prime location, or the location what you wanted. It is a very good building customized for a factory, and you have good machinery inside, you have furniture inside. When you calculated the individual fair values, it is costing you 8 lakh US dollars. But the owner said, boss, I can sell it only for 1 million US dollars, which means 10 lakh US dollars. You are ready to pay 2 lakh rupees more, because if you buy this factory, you can start business from this second onwards, from this particular moment onwards. But if you want to buy the land, purchase the machinery, commissioning, installation, then testing, then the required infrastructure, the factory sheds and all you want to do, how difficult it would be? Will it take 6 months, 1 year? And then so much of risk involved, not only the time. So you are buying piece of your life with this 2 lakhs, and you are starting the project immediately. So you have given a check. You said, bro, you are 1 million US dollars. So from this second, this factory is mine. The seller said, congratulations to you. So ho gaya, transaction is over. Now you came back, you are sitting in your office, you open your laptop and you want to pass the journal entry. 2 options came to your mind. Option 1, I bought a factory. Shall I pass a journal entry? Factory account debit. How much I paid? 10 lakh dollars or $1 million. Credit goes to bank. I paid, through bank. So credit goes to bank. So shall I debit factory 10 lakhs and credit bank 10 lakhs? This will be the first thing that comes to a student if you are in elementary level. But if you are little above elementary level, then your mind says, hey, hold on. There are non-depreciable assets, depreciable assets in the bunch. And there are different assets with different rates of depreciation. How can you recognize factory as an asset? Factory is not an asset here. Different assets you need to recognize. So option 1, debit factory, credit bank is ruled out. Go to step 2, option 2. Option 2 is recognize assets individually. Now you'll say, Pavan sir, this is correct. We'll recognize individually. Then comes the bigger problem. When you start recognizing land, debit 2 lakhs, building, debit 3 lakhs, machinery, debit 2 lakhs, furniture, debit 1 lakh, the total is, my dear friend, 8 lakhs only, but you paid 10 lakhs. So look here. Don't you think there is a difference between debits and credits? What to do? Next second student will jump into a conclusion. Pavan sir, will do one thing. Goodwill debit. Hello, hold on. My dear friend, you are not buying a business. If you buy business, then you can write goodwill debit. Amalgamation. Purchase of a business. Mergers. Then you can write goodwill debit. But if you are buying only assets without any business attached to it, you cannot recognize goodwill. That is against accounting standard. That is against IFRS. We call it IAS 16, International Accounting Standard 16, which is nothing but IFRS. In India, we call it Ind AS 16. Same principle is there in Accounting Standard 10 also. Now the question is, I cannot record the assets at their individual fair values, because if I record, there is a difference between debit and credit. I cannot create goodwill with 2 lakhs. Now what am I supposed to do? My dear friend, this issue was never dealt with in your old accounting standard. Now, maybe if this transaction comes as a practicing CA, if 5 years back or 10 years back, if this situation comes, with common sense, I would have done the same thing. With common sense. But it is not clearly given to a student that beta, in this situation you need to do this. That is not taught. Now all these kind of situations are coming into the picture. Now, apart from this, I'll give you another very interesting situation also. Imagine you went to a shop and you bought a laptop with 50,000 rupees and you also bought a printer. So you asked the storekeeper, brother, what is the cost of this laptop? He said 50,000. What is the cost of this printer? 10,000. Then he said, sir, we have one combo offer today. We have one combo offer today. You said, Bolo, what is the combo offer? He said, pay 39,999, take both. Now you're like, hey, hold on, wait. What is the cost of laptop? 50,000. Cost of printer? 10,000. Total should be 60,000. But they are giving you it at 39,999 rupees only. You open Amazon, this is the situation. Yes or no? So every day we are coming across situations like this only. Now you paid 39,999 and you bought the printer and laptop, that is fine. Seller, how will he recognize sale? Now imagine if item 1, item 2, which are combined into a combo, if they are subject to different GST rates. Bold now. How? The answer for this example and the answer for that case study is same. Apportion the purchase consideration proportionately in the values, in the ratios of their individual fair values. So total you paid $1 million here. Okay, and you bought 4 items. These 4 items put together is 8 lakh US dollars. So apportion 10 lakh US dollars or $1 million US dollars to land, building, machinery, furniture in the ratio of 2:3:2:1. You understand? Don't you think it has lot of logic and common sense wise also this is correct answer? Because unless you do it like that, how will you recognize, individual item to charge depreciation subsequently? Because in valuation, depreciation or amortization plays a very big role. So this is the only way. Now what is the accounting? Look here. Asset. So I'll show you what to do. Asset. So we have land, and then we have building, and then we have machinery, and then we have other items or furniture, something. Okay, fair value. Fair value. What is fair value? Fair value is 2, 3, 2, 1. Correct? 2, 3, 2, 1. So total is 8 lakh US dollars. Total is 8 lakh US dollars. 2 plus 3, 5, 7, 1. Correct. Now, so amount to be recognized as an asset. Amount to be recognized. So total I have paid 1 million US dollars. Now this 1 million should be apportioned between these 4 in the ratio of 2:3:2:1, which is their individual fair value. Okay. Now simple. Take a calculator. 10 lakhs divided by 8 portions. 10 lakh divided by 8 portions. So it will give you 1,25,000. Into 2 portions goes to land, $2,50,000. Then 3 portions goes to building. Is it 3,75,000? Then 2 portions again, is it 2,50,000? Then 1 portion is 1,25,000. Now add all the 4. Are you getting 1 million US dollars? Happy? Now the journal entry would be, you need to pass a journal entry. Journal entry, you'll say debit asset. Okay, so debit land 2.5 lakhs, debit building 3.75 lakhs, debit machinery 2.5 lakhs, debit furniture 1,25,000, credit bank 10 lakhs or 1 million US dollars. Now the account tallied, no? So isn't it very interesting? Similarly, in the other example, when I said that, when there is a combo purchase, so laptop, which is 50,000 rupees, or you call it dollars, rupees, it wouldn't make any big difference. Accounting remains same. Printer, which is 10,000, and the combo offer is put together 39,999. Now what you are supposed to do, take this 39,999 divided by, this is in the ratio of 5:1. So total 6 portions divided by 6. So 6,666 rupees 0.5 into 5 portions goes to laptop. So 33,333 will be laptop. Then 1 portion goes to the other one, 6,667. Okay, so 6,667. That's it. Now the seller or the buyer, whether you are buyer or seller, you need to pass the journal entry like this. Okay, you can debit cash. Why? I am receiving cash, no? You can debit cash. Why? Because I am receiving cash. How much? I will receive 39,999. This is 6,666 only. Okay, so I'll debit cash with, excuse me, I'll debit cash 39,999 and I will credit sale of laptop, and I will credit sale of printer. Sometimes this gains more importance when, imagine a situation where you are buying laptop with 2 years extended warranty. So the seller is getting 39,999 not only for sale of good, that includes sale of good, that includes sale of service also, annual maintenance contract. Maybe that could be for 3 years. So what they do, I received 39,999 as a seller. So I will debit cash 39,999. Okay, 39,999 is the cash I have received. In the credit, I write sale of good 33,333, sale of service 6,666. And this, if it is a service for 3 years, it will be apportioned to 3 P&Ls, because you cannot take it to 1 P&L. No, you have not earned 3-year service. So first year you will take 1/3 portion, second year 1/3 portion, third year 1/3 portion. These kind of situations were not there earlier. Maybe in reality they are there, in accounting they are not there. In accounting, we have never done accounting for these kind of things. I have done cost accountancy, I have done chartered accountancy, at foundation level or inter level or final level. And I have done ACCA also. In ACCA, you call it F level or P level. I have come across this kind of questions. But now that even in India, we are implementing IFRS in the name of Ind AS, this is high time for us to look at this kind of situations. Otherwise, I am telling you, 99% of students, they have given a wrong answer to me. They said, Pavan sir, that 2 lakh rupees of or $2 lakh of difference is there. No, goodwill we will debit, Pavan sir. So they'll write land account debit, building account debit, machinery account debit, furniture account debit, goodwill account debit, credit bank $1 million. That is a wrong answer. You need to take it proportionately. You understand? So this, we are launching a course for 30 IFRS. Okay, that will be taught in 84 hours lecture plan. It is a full length course, and you will be certified when you pass the exam through ACCA, Diploma in IFRS. Exam, if you write ACCA, when you pass the exam, they'll give you certificate which is recognized around 160, 170 countries. Okay, so if you are interested, enroll today with IFRS Pro and get global certification. So many videos are yet to come. It is going to be a series. So we'll discuss the concepts, we'll discuss recognition measurement, we discuss so many case studies like this, and we also practice so many MCQs. So this is going to be a full-fledged, a package under one roof for all the IFRS. Okay. Thank you so much. Keep watching IFRS Pro.